Welcome everyone to FX Streets. Today is Monday, December 27th, 2010. Welcome back one and all. Great you could join us. My name is Adam Rosen. Very happy to join everyone just as we close out the year 2010. Certainly it's been an interesting year. And what we are going to discuss today are the issues at this point. Now, certainly it's very difficult to anticipate what will happen in the year to come economically or in any matter. But what we're going to do is try to identify what we believe right now could be the key forces that would drive the markets in the year 2011. It'll be interesting to see, by the way, I believe this webinar is recorded, so it'll be interesting to see playing this back weeks and months and maybe years from now to see if we're right. But as of December 27th, these are some of the big issues that I think will drive the markets into next year. And the benefit is that if we can identify these forces and these reasons why the markets may move, we could do a very good job of putting ourselves on the right side of long-term trends and even the short-term trades that we can find within those long-term trends. Now, before we get started with the fundamental issues, which we certainly will tackle in great detail, really briefly, what we're looking at right now is a weekly chart of the Dow Jones Industrial Average Futures, the symbol is YM, 11,477 at the moment. The indicator at the bottom, which we don't really discuss a lot in terms of the foreign exchange market, is volume. Trading stocks is a different story. Volume is a very, very important feature of trading stocks. And what traders will say is that the bigger the volume, especially in proportion to what we've seen recently, the bigger the volume, the more significant the move is. Meaning if the market hits what we think is a pretty significant high, accompanied by low volume, well, that doesn't mean very much. But if the market hits a high on very, very big volume, that means a lot more. And oftentimes, big market reversals will occur alongside with very, very significant amount of volume when this volume really spikes. And, certainly the volume spikes during the earnings seasons that occur quarterly, 4 times a year, and as well upon the release of really significant economic news. But I think most of this revolves around the earnings seasons, January, April, July, and October. We have March of 2006, we had a very significant spike. We have June of 2007. Remember, we hit those very, very significant highs back in the top of the market. March, the end of March, April of 2008. Then we saw that very, very big spike lower, September of 2008, and then a move back up, and even a more incremental spike up higher, May of 2010. Notice overall the volume has continued to decrease over time. This is a natural event. Over time, volume will increase and decrease depending on really the market cycle. Moving into more, let's go to a daily chart actually. Moving into more recent times, we can see the volume most recently hit very, very significant spike highs May of 2010 and eventually moved to the downside. Now that day, May of 2010, was that huge day when the market had the 1,000-point reversal, the 1,000-point range from low to high. But aside from that, the market hitting significant lows and eventually reversing back to the upside. Recently, on the daily chart, we can see the volume has certainly significantly decreased over time, going from the end of November through the end of the year, which is to be expected. As we're going to see on the economic calendar, we see less and less economic events towards the end of the year. But starting January, we certainly would expect the market volume to increase. After all, take a look at last December. You can draw another horizontal, or I should say a diagonal line. Beginning in November through the end of December, that was 2009. See how the volume decreased? And all of a sudden, January, February, getting into the first earnings season of 2010, like we expect 2011, we certainly expect market volatility to increase and the volume to increase. And then the volume cools down, and then we have another spike. Then the volume cools down again, and the cycle repeats itself. What we're looking at now is the Dow Jones Industrial Average hovering near 11,500, at least on a futures basis. And the fact that the volume has decreased means that I think we have less of a chance of hitting an ultimate reversal point right here. But if we see the market start to hit very significant highs and then show signs of reversal upon the release, or accompanied by, I should say, big amounts of volume, I would consider that a lot more indicative of a possible reversal to come. Coming into January, we expect the volume and volatility to increase, and eventually, if a reversal takes place, I think it'll be accompanied by very, very large amounts of volume. Let's get to some of the major issues that I think could play a prominent role in the year 2011. Taking a look at FX Street's 10-year, or not 10-year, I should say, monthly calendar, or actually daily economic calendar. I'll send everyone the link, by the way. Really nice calendar because you're able to adjust the calendar to whatever day range you'd like, as well as filter out only the most significant events, which I have done. Heading towards the end of the year, these are the only big events that we would expect to see. Today we have mostly numbers coming out of Japan, including retail trade, industrial production, CPI, and many others. Tomorrow we have UBS consumption indicator in Switzerland, U.S. consumer confidence. December 29th, Germany retail sales, Germany consumer price index, KOF leading indicator in Switzerland, pending home sales in the U.S. on the 30th, 31st, not really a lot. Nationwide housing prices in the U.K., few other numbers. Heading into the first quarter of next year, January, February, March, the big events that we expect to see. Bank of England interest rate decision, European Central Bank interest rate decision, the Reserve Bank of Australia interest rate decision, and the Swiss National Bank interest rate decision. 4 big central banks all expected to release their interest rate decisions next year. Now, not too long ago, we held a webinar discussing the central banks and the most recent interest rate decisions. For those of you who did not join us, what we basically did is we went back to the most recent monetary policy statements released by each respective central bank. We read into their language, trying to make an educated guess. Is each central bank, how do they basically feel? Are they leaning towards raising interest rates because all central banks have really cut interest rates historically, or are they leaning towards the side of not raising rates? Some central banks are certainly a lot more optimistic. Now, for example, we read about the Bank of Canada. Well, a few months ago, we were raising rates and we're quite optimistic. Since then, the Bank of Canada has certainly tuned down their optimism, and it's anticipated the Bank of Canada may not raise rates through the brunt of 2011, at least as it stands right now. Then we have the Reserve Bank of Australia, Reserve Bank of New Zealand, although a little bit not as optimistic as maybe they were a few months and quarters ago. But I think, if and when the U.S. and other economies turn around, I think the Reserve Bank of Australia and New Zealand are good candidates to some of the first central banks to raise rates. European Central Bank, on the other side of the spectrum, they don't want to raise rates. They have a 2% growth target, GDP, gross domestic product, which the European Union or the European economy is barely able to even meet. And we need that GDP to exceed 2% for the European Central Bank to consider raising rates. They're not anywhere near there at all. And inflationary pressures have continued to not increase and actually subside in some cases. So I'd say the European Central Bank is on the other side of the spectrum. Bank of England, well, not as optimistic as maybe they were a few months ago, but we did read an article from Bloomberg.com. There was a prominent analyst who did anticipate, if I remember the article correctly, Bank of England, many believe, may raise rates 4, maybe even 6 times in the year to come. Well, if we expect the Bank of England to raise rates from 0.5% to maybe 1 or 2 or maybe even 3%, after 6, consecutive increases, that would certainly bring up interest rates quite a bit in the UK. And as the foreign exchange market, like any market, is a forward-looking mechanism, as the market anticipates that the Bank of England would raise rates, well, I certainly would expect a lot of strength in the British pound. We don't really see a lot of evidence of that so far in the actual pound currency. But I'm certain that if the Bank of England, if the market anticipates Bank of England will raise rates, I certainly would expect a lot of strength to go along with the pound to the upside. U.S. dollar, U.S. economy, the inflation rate is positive just by maybe a margin, negative under some indications. And really, with 9.8% unemployment, like the 10.1% unemployment in the Eurozone, not a lot of reason for the Federal Reserve to raise rates. Watch the incremental numbers, because that is what that's what all of the central bankers watch when they make the decision to raise rates, lower rates, or keep them unchanged. The question is, will you see the pound rate futures rising in some index? Yeah, it's a great question. Yeah, you could see the futures rise, or you would see, yeah, absolutely the futures rise. I don't necessarily know if the futures based on the actual currency would be of any value to us, meaning I don't think that we could watch necessarily the futures on the British pound or the futures on the pound dollar currency pair. I don't know if watching those would necessarily give us a forward-looking mechanism, to see if the pound would eventually go up. But your second comment, I think, hit the nail right on the head. I would absolutely watch the interest rates or the bond rates. For example, the 10-year bond rate is a very, very commonly watched barometer. Compare, and analysts, Bloomberg.com almost every single day prints one article or another analyzing the difference between the U.S. 10-year Treasury notes or Treasury bond, 10 years as a Treasury bond, the U.S. Treasury, 10-year Treasury bond, the 10-year German Bund, the Australian 10-year bond, the European, the Euro, I should say, 10-year bond. Compare the spread or the difference between those 10-year bonds. They're not going to be the same. Obviously, those yields will revolve around the U.S. 10-year Treasury bond will revolve around U.S. interest rates, also influenced by, Fed funds futures, meaning what is the anticipation that the market will, or not the market, but the Federal Reserve will raise or lower interest rates in the near-term future, also influenced by that respective stock market, the Dow Jones Industrial Average or the NASDAQ in terms of the U.S. Economy. The 10-year bond, I think, is probably the best indicator to watch in terms of trying to anticipate long-term moves. I'm sure a lot of you are familiar with the Excel sheet that I'm going to pull it up in just a little bit. I track a number of economic numbers on an Excel sheet. One project that I've really been anxious to begin, I haven't really had a chance to get the data and start plugging it in yet, but it's my next mission is to compare exactly that. Compare the 10-year Treasury bonds to the 10-year German Bund, to the 10-year Euro bonds, etc. Watching the fluctuation, comparing the interest rates and the movement in those bonds between different markets, I think could give us, my theory is I think it could give us a really, really nice idea as far as which central bank is most likely to raise or lower interest rates. I think you'll definitely see that movement in the respective bond markets. It's a great question. Great comment. Now, so we know the central bankers and the respective central banks have a very, very large effect to the direction of interest rates, and it doesn't really start there. What it starts with is the economic calendar, the big numbers, PPI, CPI, non-farm payrolls, central bank meetings, employment numbers, GDP numbers, etc. We talk about a lot of them. See FX Street's calendar, though. It can really be a great source of information as far as what economic numbers we expect and the anticipated result of those numbers. Number two of the big stories, and I think this is huge. This was, by the way, reported on Bloomberg.com not too long ago, just earlier today. China's monetary tightening in 2011 may be mainly in the first half as officials tackle the fastest inflation in more than 2 years, J.P. Morgan Chase and Morgan Stanley said. The People's Bank of China increased key one-year lending and deposit rates by 25 basis points on Christmas Day in its second move since mid-October. The change took effect yesterday. China's stocks fell, erasing earlier gains on speculation the central bank will accelerate increases in interest rates. Bonds dropped and yuan forwards climbed. China is not only one of the huge participants in the world economy, they're also one of the largest consumers, or not consumers and also producers. Consumers of raw material, producers of finished goods that eventually make its way to the U.S., Europe, and many other places. In addition, China represents one of the few economies that is really firing on all cylinders right now. The inflation is really very, very strong in China. And as a result, as much as they have not wanted to, the Bank of China has now raised rates twice in the past few months. We know as inflation continues to increase, remember back in the U.S., or back, 2006, 2007, when the European Central Bank, Bank of England, Federal Reserve, when the economy was firing on all cylinders in our area, our respective central banks would raise rates to slow down the economy. The inflation rate in China, I'm going to zoom down in this article to see if they give us a current inflation rate. It has been a very, very strong. Benchmark lending rate rose to 5.81% compared to 7.47% before cuts in late 2008. Deposit rate increased to 2.575%. I'm looking for their inflation rate. Sometimes they mention it. Consumer prices rose 5.1% in November from a year earlier, the most in 28 months, mainly driven by food costs across 70 major cities. I don't see the actual inflation rate, but the consumer prices is a pretty close indication, which again, 5.1% in November. Now, as the Bank of China is anticipated to keep on raising rates, that will naturally slow down the Chinese economy, but in turn could affect all of us. Reason being, think of the Bank of Japan. The Bank of Japan, like the Bank of China, or the Bank of Japan, or I should say the Japanese, like the Chinese economy, they're both export-driven economies, not like the U.S. And Forex Fundamentals 101, we talk about different types of economies. The U.S., the European Union are capital-intensive type of economies, meaning that the U.S. economy benefits from capital investments. That's why stock markets tend to go up, which tend in turn lead to the dollar rising, because foreign investment comes into the U.S. and in turn is invested in our U.S. stock markets, U.S. housing markets, etc. The Chinese and Japanese economies are different because they are export-driven economies. They benefit from exports. Exports represent the majority of their respective economies. The reason why the low interest rates make the Japanese and Chinese products so attractive is because low interest rates naturally keep down the Japanese yen against the dollar and naturally keep down the Chinese yuan against the dollar. The dollar and the euro and the Australian dollar can certainly buy more yen and buy more yuan than, when interest rates are low. However, eventually those economies just become very, very hot and those central banks have to raise rates. The Bank of China has to raise rates because things have gotten so inflationary, and they mentioned particularly in terms of food costs that the citizens of China simply cannot afford the food. I cannot remember exact numbers. I've heard some unbelievable 10, 20% inflationary increases over time in China. So the central banks have to raise rates. The Bank of China is certainly very reluctant to do so. But as the Bank of China raises rates, that's going to slow down the economy. It will in turn slow down Chinese consumption of raw materials, primarily coming out of Australia and New Zealand, and will also to some extent slow down the consumption out of U.S. products, goods and services, and Chinese investment into the U.S. So what's good for China is really good for the world. What's bad for China is bad for the world. Because the Bank of China has started to, or now raised rates for the second time, this could weigh on not only the Chinese economy, but overall. Dollar Swissy? Well, I'm going to get to the chart in just a moment, but I would say the trend is your friend. The trend is to the downside. Actually, let's take a quick look at the chart because it kind of ties into what we're talking about. Here's a Dollar Swissy daily chart. We're at 96.20 right now. Now, look, if we go to a monthly chart, the long-term trend is to the downside in Dollar Swissy, and there's really not a lot of reason to believe that this long-term trend is going to stop. I think a lot of this is primarily due to the budget deficits. And I heard of a statistic on the news earlier this morning. What did they say? They said that in the next, let me see if I can get this number right. Two statistics. First of all, the interest between now and the next 10 years, the interest that we will have to pay in the deficit will become our largest component of the debt, meaning it will actually exceed national defense in the U.S., only the interest payments alone. And furthermore, the interest has risen more, or we have now pay more in interest. We do now, between now and the next 10 years, we will then pay more capital on our interest on the national debt than we did from, I believe, 1776 through 2005. So, not a lot of reasons for the Federal Reserve to raise rates. It is more dilutive to the U.S. dollar. Therefore, I think the dollar will continue to go down. Now, if gold starts to move to the downside, it looks like it's kind of hit a consolidation pattern on a daily chart. If gold starts to move down, that could bring the Swissy down, and in turn the dollar Swissy can move back to the upside. What makes me skeptical about getting in a short right now in the dollar Swissy is a possible double bottom. We hit lows in 94.61 October 14th, a higher low of 94.97 on December 23rd. However, again, long-term chart is certainly still to the downside, but to get in a short trade, I would rather do so near projected resistance. Daily chart shows us the downtrending resistance emerges near the 99.30 level, possibly. So, dollar Swissy, long-term trend, I think to the downside, but again, the entry close to the 9,900. Immediately we could see a bounce back higher. Look, we could break this downtrending resistance and go a little bit higher than that, go much higher than that. But not a lot of reason to think that this very, very ultra long-term trend has necessarily stopped either. Weekly chart on the Euro Swissy, 126.55, similar situation. Not a lot of reason to think that the European economy is going to get out of the woods quite yet. We still have 10-point-something% unemployment in the Eurozone. 124.37 were the previous weekly candlestick lows. Kind of looks like a projected support level, parallel to resistance. Downtrending channel, I think, is still intact, but to get short, maybe as high as 142. So, dollar Swissy, dollar Swissy, and Euro Swissy, long-term channels to the downside. Entries, unfortunately, not right here. I would not want to buy either, even though it might go up. I would not want to buy either because that would be fighting a long-term trend. Sometimes the trends turn back to the downside near their projected resistance, sometimes unexpectedly. Another big issue coming into 2011 are the income tax cuts, or the Bush tax credits that so far have been extended. My pleasure. Bloomberg.com earlier today reported, I'm just paraphrasing here, in a compromise with Senate Republicans, President Obama agreed to a 2-year extension of tax reductions for family income above $250,000, coupled with an extension of unemployment benefits. And, of course, the issue will come up again before the 2012 elections. The Bush tax credits, which so far looks like they have been extended, if they were not extended, would certainly weigh on the small businesses and a good portion of the U.S. economy. We will see. This issue is not over. So far, I think this is a positive with a question mark, although we don't know what's to come. That is a big issue. What else do we have? We have a lot going on here. Something else very, very timely. Anybody living on the East Coast in the U.S. has probably seen a little bit of snow fall over the past couple of days. On Bloomberg.com, U.S. retailers expecting to ring up sales in the days after Christmas may have to intensify discounts after a snowstorm slammed the East Coast yesterday, disrupting one of the busiest shopping days of the year. Remember, after Christmas, we have that back-to-shopping spree, which is not good. Parts of New York and New Jersey got as much as 2 feet of snow over the past few days, keeping many shoppers at home. Spending may shift into January, according to Marshall Cohen, Chief Industry Analyst at NPD Group, a research firm based in Port Washington, New York. I know also there has been some not so nice weather in many parts of Europe as well. Now, Cohen said, by the way, in a telephone interview yesterday, he says, quote, "It's like throwing a party and nobody comes because the focus has gone from post-holiday shopping to post-holiday travel. Look for sales to be repeated by retailers who are going to become more aggressive. They've got to throw another party. Well, I will take everyone back to one of my favorite trading stories. This is back in the day when I used to be a stock day trader. And we would always look for the non-obvious news. You see, when AOL reports earnings, it's very, very obvious. We know everyone is watching the news. But the best trades come from those events that most people don't really pay attention to. One of those events took place, what year was it? I think it was 2002, 2003, when the home builder stocks were just starting to come off very, very significant multi-year lows. And the retail stocks were also coming off of very, very significant lows. And the retail stocks had nice trends to the upside at that point. And when we talk about retailers, we have the online retailers like Amazon.com and BarnesandNoble.com, but we also have, and Apple, of course. And we also have those brick and mortar retailers like Marshalls and JCPenney's and Sears and all those, Circuit City, which now out of business, Best Buy, etc. All those big stores that we go to, especially during the holiday season. Now, we had in February, not only in New York, but all over the East Coast, everywhere from Maine and Boston down to New York, Washington, and even a little bit south of that. We had a tremendous snowstorm. And I remember walking through the streets of New York at that time. This snowstorm occurred during the President's Day weekend, which is a huge shopping weekend. Not as big as Christmas, but it's still a huge shopping weekend when a lot of those stores go on sale, especially in the automakers, but retail sales overall. And a lot of those stores, even in New York City, did not even open up that day. Saturday and Sunday, they were expecting a lot of shoppers. The stores weren't even open. Well, Monday morning or Tuesday morning, when the stock market reopened, came along. And I remember thinking to myself, well, all of these retailers, they were expecting a lot of shopping because I kind of expected to go shopping. And the stores were closed, and I'm sure I wasn't the only one disappointed. So I decided, well, I bet the retailers, or better yet, the analysts who expected those retailers to report all these fantastic sales, and they pushed up their earnings estimates based on the fact that they anticipated to sell 1 gazillion flat screen TVs and GM cars and all that other good stuff. Everybody was probably disappointed. They didn't factor in this really, freak snowstorm based on the fact, they didn't anticipate the snowstorm when they were looking at their earnings estimates. Well, I decided to sell short every retail stock I could think of on the market open. JCPenney's and Sears and, all those other great stores. And the stocks opened up basically flat, maybe down 10 cents. And within about 20 minutes, all the stocks just got clobbered because from the moment that the market opened at 9:30 a.m. in New York until I don't know, 10:15 or 11 o'clock, every single analyst on CNBC started to wake up and realize, hey, the stores are closed over the weekend, and everywhere from Maine down in Boston down to Washington, people couldn't go shopping. We were wrong. I don't think Sears is going to sell as many snow tires. Ironic that they couldn't even sell the snow tires that they were expecting to sell. Point being, I think the snowstorm coming until now will play a very, very important role. As well, travel industry. Those airlines, although airlines never really make a lot of money, I think the really big trade on this is the retail industry, which Bloomberg.com so accurately reported on. Now, Boyke did mention a very, very important factor. And I don't think this issue is going to last all the way through 2011, but we do have earnings season in the first month of 2011 in January. So this could be the January trade. Now, may not be, a perfect trade in the foreign exchange market, but then again it could because, if we expect the retailers to report the earnings lower than estimated, well, I think that's going to send the stock market down. And we know how the foreign exchange reacts when stock markets go down. When stock markets go up, we tend to buy the higher yielding currencies like the Aussie and the Kiwi, and we tend to sell the lower yielding currencies like the dollar and the yen and the Swissy. And this could also certainly hold true to, Europe and the UK as well. When stock markets go down, we tend to sell everything else, especially those currencies with the higher yields, and buy the low-yielding currencies that are considered a safe haven of capital, like the yen, like the dollar, and like the Swissy. The dollar, I don't expect to see huge trends to the upside. So I think if you're going to buy a currency based on the snowstorm, I think it would either be the yen or maybe the Swissy, because I think we're going to sell everything else and buy those lower yielding currencies, again, like the yen and the Swissy. Now, Borky did make a great point. If we can't get to the stores, most of us still have internet. And we know Amazon.com in particular is one of those companies that really benefits from online shopping, especially around the holiday shopping season. So what is bad for JCPenney's and what is bad for Sears could be good for Amazon. Sounds like an arbitrage trade, selling short Sears and JCPenney's and going long Amazon. Or, there are certainly other retailers out there. Just to give you food for thought, though. By the way, speaking of earnings season, earningswhisper.com, I love their calendar. I've been using it for years. This shows us, there's a link by the way, this shows us every day, and we can look forward on the earnings calendar, what companies are scheduled to report earnings. We have the fourth quarter earnings such as Lennar, that's a big home builder by the way. That's scheduled to report earnings, I believe, what's that today? Is that today? No, I'm sorry, January 3rd. January 3rd is Lennar. Look to the earnings calendar coming into January. The big days in the stock market, remember we talked about volume, those big days are usually accompanied by those big companies. Big companies, we mean the Dow Components, the Dow Jones Industrial Average components. Those 30 stocks represent the Dow Jones Industrial Average. Here, by the way, is a link of the Dow Jones Industrial Average. Companies including 3M, Alcoa, American Express, AT&T, Bank of America, Boeing, Caterpillar, Chevron, Cisco, Coca-Cola, DuPont, Exxon, GE, Hewlett-Packard, Home Depot, Intel, IBM, Johnson & Johnson, JP Morgan, Kraft, McDonald's, Merck, that's pharmaceuticals, Microsoft, Pfizer, Procter & Gamble, Travelers, UTC, that's United Tech, Verizon, Walmart, and Walt Disney. Walt Disney may be affected by the snow as well. What if we can't go on vacation and arrive at Disneyland or Disney World? Watch those days and those big Dow Components report or scheduled report earnings. If, General Electric or, Walt Disney, for example, if they beat or miss their earnings, that could lead the entire stock market for that day. Here's another clever website I ran across, by the way. This is from, Marketwatch.com. Click on any link, any day I should say, and it will give you the companies are scheduled for earnings that day, such as Wednesday, January 8th. We have Costco. Not a lot of big companies from what I can see. I don't recognize really any other big ones here. All right, United National Foods, that's not huge. At any rate, check out that website as well. It can represent a really nice resource. And as well, coming into next year, well, I love the stock. The stock market, was my first venture into any financial market. So I'll always go back to the stock market. But, with the foreign exchange markets, I love the stock market. The foreign exchange market, I think it's important to consider the stock market because, one hand really washes the other. And, to consider the stock market, I think conversely we should, consult the foreign exchange market. My first interest in the foreign exchange market was actually trying to find correlations between the S&P futures and the dollar currency. I was originally attracted to the foreign exchange market just because I was looking for an edge to trade stocks. Because I knew when stocks usually go up, well, bonds usually go down and bond yields usually go up. And, I figured, well, if the bond yield usually goes up, doesn't that mean that the dollar should go up as well? And what if the dollar goes up a little bit before the bond goes up, and the bond goes up a little bit before the stock market goes up? Well, if I watch the dollar, maybe the dollar will rally before the stock market goes up, and that could give me a tremendous advantage as a day trader. Well, that was my original thinking. And so I started to watch, the euro dollar. I knew nothing about the foreign exchange market. I couldn't really figure out how these pairs work. Am I trading the euro, or am I trading the dollar, or am I trading both, And eventually, I figured it out. And then I discovered really so many advantages of foreign exchange market. Very, very small spreads, 24-hour trading, tight, no commission, etc. So eventually my focus moved more and more towards Forex. But I think the more information that we can try to get our hands around, the better. And yeah, I agree. The dollar yen and the S&P 500, there are definite correlations. And the question is the dollar yen always correlated to the S&P 500? The answer is no. But sometimes yes. Is the euro dollar always correlated to the Dow Jones Industrial Average? The answer is no. But sometimes yes. And that's really, and there's no real easy way around it, but I think it makes it more fun for us. I think the proper way to go about studying the foreign exchange market and the stock market is to try to get our hands around the big issues of the day. Now, I read a book, a long time ago, that talked about, and this book was, I talk about this book all the time, Reminiscence of a Stock Operator, one of the greatest books about trading ever written. And there was one concept, one line that always stuck out in the book, and the author said that, in the past 100 years of the stock market, whatever it may be, there's only 5 or 6 stories that just continue to get recirculated and recycled. If you think about it, over the past, 50 years, 100 years, what are the big stories that affect the stock markets? Well, we have political stories, Democrats versus Republicans. We have geopolitical issues, wartime, peacetime. That kind of goes together with the political issues as well. We have interest rates, oil, we have gold, we have booms like, the railroad stocks. That was a bubble back in the 20s, and then, if I'm not mistaken, the 20s, and then the radio stocks and television stocks, and then eventually the automotive stocks into the 1950s. And there was a huge home building boom in the 1960s. Then we had that recession in the 70s. And what was a big story that time? That was oil. And that eventually led to, a really big recession in the automakers. And that's why all those big muscle cars, those big, great American cars with V8 engines went down to the very, very small cars as a result of the oil issues in the 70s. And then in the 80s, we had this resurgence in investment that led to the housing issues in the 80s, very, very high interest rates, S&L Bank problems. In the 90s, the low interest rates, eventually in the recession in 92, 93, eventually led to low interest rates, which in turn led to that tech boom in the year 2000 in the late 90s. Those very, very high levels eventually led to the stock market, that bubble that burst, low interest rates again, which in turn spurred on the housing market that brought us to the highs in 2000, that eventually led to the housing market crash, and then the cycle repeats itself. So there's only 5 or 6 big stories that go on day after day, year after year, decade after decade in the markets. And I think if we can identify what are the big stories today, keeping in mind the grand economic cycle, housing stocks will come back. I have 100% faith in that. And I think there will be another bubble. And then eventually that bubble will burst, and some will make money and some will lose money. And then, of course, the media will find its villains and will find its winners, and then the cycle repeats itself. Trying to identify that in reference to the stock market and foreign exchange market, I think, can put us on the right side of really tremendous, tremendous trends. Question: are U.S. bankers still making the market to fake foreign investors? Never like to stop bubbles. I don't know. It's a great question. I'm of the opinion, I think, that stock market booms and busts will continue to occur day after day, year after year. Now, I'm not, I don't want to completely forgive the very, very loose regulations that led to the housing boom, the bubble that eventually burst. I think that was, certainly not called for. I think housing stocks in the housing market still would have gone up, not to the same extent. I think that, when we talk about there's a term called the Chinese Wall. Remember in the late 90s and early 2000s when the investment bankers were allowed to talk to the other side, the analysts and the investment bankers would tell the analysts, hey, give me a 5-star recommendation and I'll give you shares of the stock, and then we're all going to make money together. And that led to those tech stocks, those .com stocks with no earnings that went up to $200 a share and eventually went down to zero. There are, in every economic cycle, there are villains and there are, I don't want to say heroes, but there are those who do business the right way and those who do business the wrong way. It's going to happen. I think that it puts us on the right side of the trade, not to, certainly take sides politically, but more just recognize, okay, this trend is moving to the upside, this trend has moved to the downside, this is a good time to buy this stock, and this is a good time to sell that industry, so to speak. Why do I like the Dow 30 versus the S&P 500? I like both. Just out of habit, I happen to watch the Dow Jones Industrial Average. I think the S&P 500 represents a more broad-based view of the market. And as a day trader, I would watch the S&P 500 futures, not the Dow 30 futures. But my charts that I use now, I started using quite a long time ago, just happen to offer the Dow futures, so I started to use them. No particular reason. I think you could use either one. The other issue, there's many more, which I haven't covered, but I think one of the other issues that I think will be a very, very big story in 2011, and one of the analysts I remember reporting had said the housing market got us into this mess, and the housing market has got to be the market that gets us out of this mess. This was on Bloomberg.com earlier today. Home prices probably dropped in October. A sign housing will remain a weak link as the U.S. recovery accelerates into the new year, economists said before reports this week. We had housing numbers, I think, on Wednesday. Property values in 20 U.S. cities were down 0.2% from October 2009, the first year-over-year decline since January, according to the median forecast of 14 economists surveyed by Bloomberg News. Ahead of a report from S&P Case-Shiller in 2 days. Other data the same day may show consumer confidence rose to a 7-month high in December. We have a housing market that certainly causes a lot of problems. And for those of us that are fortunate enough to be in the right position, has really created a tremendous opportunity. Take a look. This is charts that I maintain on my own. Blue line represents U.S. new home sales. We just had a number last week reported at 290,000 new sales, or new home. This is new home sales, new homes that were obviously sold. Below its 12-month moving average, but on a more basic level, we have seen a huge move down. My charts go back to the 1990s, but if I remember correctly, these are the worst numbers we've seen since record keeping began back in the 1960s. Eventually, and when we have this kind of huge move, and this was the same kind of move we saw, maybe not in exact proportions, but when the tech bubble burst in the year 2000, 2001, this dragged the rest of the economy down. What was bad for us in terms of tech stocks in 2000, 2001, the worst market now is the housing market. And I think that eventually when the housing market comes back, I don't think we're going to see a full-blown recovery in the U.S. economy and other economies as well until the housing market comes back. However, another quote I remember reading a long time ago in one of my favorite trading books is that we should always be aware that yesterday's winners will not be tomorrow's winners. It is so easy to continue to want to chase yesterday's winners. Another way to put it is, don't look in the rearview mirror when trading. Remember what the hottest stocks were in the year 2000? Things like Redback.com, that was a online security company. Remember Sun Microsystems was $60 a share. What were some other ones? Microsoft was $100-something a share. Apple Computer really did not participate to a large extent in that tech bubble in the year 1999-2000. We had Pets.com. I always like to talk about that because that was like $200 a share and then went down to $2 and eventually $0. Qualcomm, which I remember was above $400 a share, that went down to $4. Yesterday's winners, Qualcomm never came back to 400, went out of business. Sun Microsystems, haven't looked at in ages. I'm guessing it's still below $10 a share, or maybe it's part of Oracle now. I think it's part of Oracle now. It never went back up to 60. Dell, which was at $60 a share at one point, never came back. Yesterday's winners did not become today's winners. Those housing stocks and those home builder stocks that really benefited from the last not tech bubble, but the last bubble, I don't think you'll see home builder stocks so quickly like Lennar and Hovnanian and BZH. I don't think that they will necessarily return back up to, those $100, $150 a share highs. Remember the metal stocks that were really out of control, like PV, or I think it's PVE now, Phillips Dodge, that's a copper stock. The gold stocks, certainly not that far from their highs now. Those bubbles eventually will burst. Don't expect those to come back. New economic cycles are always led by new leaders. Look for tomorrow's leaders. Now, what industry will lead us into the next bubble? And we're still years away. But I think it's important to try to anticipate what that might be. That could be green energy, for example. Reason being is because the Obama administration happens to be very friendly towards green energy, solar panels, etc. Look to those industries, and there's a lot of different ways we can try to make educated guesses. What will be the next hot industry? Doesn't mean the housing market won't come back. It will. I would not expect it to come back to the highs of 2005. New home sales, this is measured in hundreds of thousands. So this is almost 4 million. I wouldn't expect it to come back. Maybe halfway back. But so far, we can see the housing market has not come back so far. We're right near the lows. What's the signal? Well, I always track it with a 12-month moving average for no other reason except this is a monthly indicator, and it makes sense to track it over the past 12 months. But, when we see the housing market, specifically new home sales, cross back above its 12-month moving average, cross back above its significant spike high of May of 2010, that's at 446,000. Point being, when you see new home sales back above 500,000, I think that's a really good signal that we might be back on the right track in the housing market. And because the housing market was one of the biggest losers in our bubble burst on the way down, we need to expect to see this to come back before we see a full-blown recovery. And of course, foreign exchange markets, the stock markets, they're forward-looking mechanisms. Market will move before this occurs. But watch the numbers. So far, the numbers have not been very, very positive. But wait for the incremental little moves to take place. And the other big numbers as well, we can take a look at the ZU number. That's German investor confidence. Kind of cyclical. Not a good number over the past couple months, though. Really disappointed the last month. We talk about the IFO number. That's out of Europe as well. These are some of the bigger numbers. The IFO number has been rather strong. Business climate and current situation numbers to be included in that. So German investor confidence not so hot. However, the IFO number is. We know unemployment rates in all respective countries are certainly very, very important. We can talk about consumer price index, such as, here's the Bank of Canada. Bank of Canada, and the violet line represents the Bank of Canada historical rates, and the consumer price index is the violet line. Inflationary pressures, we need to wait for those to come back as well. Many, many others as well. The list goes on and on. And of course, as those numbers start to improve, or in some cases continue to improve, we'd expect those respective central banks to raise rates. As the market anticipates the central bank will raise rates, we're looking at here, by the way, historical interest rates. Reserve Bank of Australia is a dark blue line. It's currently the leader at 4.75% interest rates. As the market expects the central bankers to raise rates because their own numbers start to look better and better, currencies will start to move up, new trends will develop, and if we're on the right side, I like long-term trading, but even short-term traders, day traders, scalpers, you put yourself on the right side of these long-term trends, I think overall we stand to fare much, much better. With that said, I'm out of time for the day and for the year. However, if you want to contact me, please do not hesitate. You can do so anytime, www.foreigntimes.com. I want to thank you all very much for joining us. I want to wish you all a great day, a pleasant New Year's. Very special thanks to FX Street as well. please see their calendar, because kicking off in January, we have a brand new schedule, much, much more. I want to thank you all very much for joining us. Wish you a great day, a pleasant New Year's, all profitable trades, and we look forward to it.